The markets have finally bounced off the bottom. The biggest question is this sustainable? We'll be going through in this video the reasons as to why the market believes it has bounced higher and its surrounding. Have we reached peak inflation? We'll be going through some key data points that the market took a look at this week, and we'll be giving our opinion as to whether this market can potentially go higher, or if unfortunately we have some more pain to endure. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, huge favor, huge ask. If you learn something new or you get some value out of the video, hit the like button for me. I definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on for content similar to this. We're going to be starting off with a key data point called the PCE Index, and we're going to jump over into Market Watch to read a little bit about why this is so important. So the Fed views the PCE Index, the core rate in particular, as the most accurate measure of US inflation. So they're looking at this as being the key indicator over the CPI. So let's learn a little bit more about what the PCE Index is. So we come over to this BEA website here, and we can see that the PCE, which is known as the Personal Consumption Expenditures Price Index, is a measure of the prices that people living in the United States or those buying on their behalf pay for goods and services. The PCE Index is known for capturing inflation or deflation across a wide range of consumer expenses and reflecting changes in consumer behavior. So we know that the CPI doesn't really cover so many things. In Canada, we've talked about it before, they just added the used car index. I believe it's supposed to come in this print or the next print. So the CPI doesn't really gauge a full understanding of what's going on in the market, whereas the PCE can do a little bit of a better job of figuring out where people are spending their money and what that looks like on a realistic inflation level. So we got some key data coming out May the 27th, and we see that there was a decrease in the PCE index. So it went from 6.6% in March of 2022 to 6.3% in April. So on the downcline, and what people are basically buying into the market is saying that we have reached the top on inflation, but we all know that this is still too early to tell. Now that we know that the PCE index is moving in the right direction, we know that the next release here is June 30th, so stay tuned for that. You can come to this website. I'll link it down in the description below. But we're going to move on to consumer spending. That was another key data point this week in which it surprised the market. So let's look at this. We see that consumer spending as a whole accounts for more than 2/3 of US economic activity, and that increased 0.9% last month. And the data for March was revised higher to show outlays of 1.4 instead of the 1.1 previously reported. So what are people spending on? Well, they're still spending on goods. We're speculating that this was supposed to be going on a downwards trend, but it still looks to be gaining. We see an increase of 0.8% here, driven by new motor vehicles, clothing, footwear, etc., etc. And we also see the services on the up trend as well. We see them rising about 0.9%. I would speculate that this would probably outpace the goods sector for the next couple of months. But we're basically seeing here that the markets are seeing that the US consumer is still strong. They still have money to spend. You know, this article goes on to talk a little bit about the strength of the consumer, just to say that it's being supported by a massive savings as well as strong wage gains, with companies scrambling to fill 11.5 job openings. So one of the things that makes inflation sticky is the fact that wage growth continues. So if the wages keep up with inflation, it makes it sticky. It makes inflation stay around for a longer period of time. But taking that aside, let's break down the savings comment there. So obviously everybody was trapped in their house. during the lockdown, probably more in Canada than in the US, but it still allowed the opportunity to put in savings. So a lot of people that were afforded that luxury of staying at home and not having to spend were able to put that money in the bank. And I think that's reflected when we look at the personal savings rate. We'll start with the US. We can see in 2020, this spiked all the way up to about 30% of the income was saved, essentially. And now we're starting to see a huge downtrend that we've dropped to levels not seen since 2008. So when we take a look about that savings comment in the Reuters article, I'm not so sure if I'm completely on the same page. I definitely think that we are kind of going through a little bit of an anomaly right now, in the sense that we could be bouncing a little bit higher, but as inflation continues and the consumer deteriorates, we could be heading on a little bit of a downtrend. But that's a little bit of a sneak preview. We'll look at the Canadian household savings rate, and the story is very similar. 2020 spiked up almost 30% on the Canadian side, and now just above the 6%, which has fallen into average, which is kind of around the average territory, which is awesome. So, staying in trend, but definitely on a downtrend from the big spike that was there. I think what I'm trying to say here is we're not in a position that we were in 2020 where people were flush with cash. That is definitely not happening today. We see it in both savings rates in both countries, but we'll even take a look next about what the economy is saying about the consumer sentiment. How confident are people about going to spend, going to buy on new things, going to invest in new things? Or are we at a part in the market where people are holding on to their cash? And we've touched on this in a similar video, so I'll link that above to learn more about the University of Michigan's Consumer Index. We will throw the chart up right now to give you an indication that consumer sentiment has never been more bearish since probably going back to the 2008 to 2012 period, where people were very concerned about the future. So it is not really a good sign, and we could be seeing the last of these good prints when it comes to spending. We could actually be seeing a downtrend in spending from here. And it almost goes back to the point that I made in a previous video a couple weeks ago, talking about demand destruction. When we continue to raise the prices of goods and services, essentially you're going to kill the economy that way. And to add on top of it, we could be heading into a policy mistake where the Federal Reserve is raising the interest rates too fast and too soon. So there's a couple different things that make it seem that I do not believe that we are going much higher from here. We may go 5% higher, but when these data points start coming out, that's when we could feel a little bit more of the pain. But yeah, we got decent spending coming out. But with the savings rate low, how much more can we continue to spend if inflation continues to rise? We also have the federal government's tightening the money supply. I think there is unfortunately more pain to go, but let me know what your thoughts are. Do you think the market bounce this week was a super positive thing and we're going to go higher? Or are you a little bit concerned right now with what you're doing with your portfolio? And if you're still here with me, I appreciate your support. Hit the 1K mark, so I appreciate everybody a part of the community. If you're still here with me, hit that like button. I hope you all have a great week in the markets. Happy trading.